Good morning and welcome to this session today. My name is Simon Gashahe, Head of Premier Banking. I'd like to really welcome our customers to the first session this year, our first customer engagement session this year. Today we're going to be talking about the property market outlook and opportunities for 2022. And we're going to be partnering, we've partnered with Knight Frank to really bring you information about the property market, what to expect as far as the property market is concerned, how you're going to, how it plays out with your plans, and how ABSA then comes to support your dreams as far as properties are concerned. We're going to have quite an engaging session today. We encourage a lot of interaction with yourselves. We encourage you to send questions as much as possible on the Zoom chat box on Zoom. We encourage you to also give feedback as much as possible as you go into as we go into the session. A bit about the session and why we are doing this. The session is giving you a deep dive into the property market as is today. Why we are doing this is because we've got a lot of feedback from customers as to what areas they want us to talk about, areas that they would like to find more information about. And this is one of those sessions that we have set out. As I've mentioned before in the other sessions, this is not just a unique one-off session, it's a series of sessions. In fact, just to mention, we have 12 sessions set out for this year, this being the first session. And we look forward to partnering with you as we unpack various topical issues that we think you'd be interested in. In the panel today, we have 4 people who we get more detail about on the introduction. But just as a highlight, we have Ben Woodhams, the MD of Knight Frank. We also have Tarquin, the head of residential in Knight Frank, the residential agency. We also have Charles from Knight Frank. He's the head of research, gives us a lot of detail and deep dive into the trends. And then we also have John, who is our head of mortgage for ABSA, who then ties it all up together. What solutions are we giving you to be able to access any properties or the property market? Where are we partnering with Knight Frank? For all of you who know, Knight Frank is quite a reputable organization looking at real estate and the property market for over 125 years globally, about 24 years in Kenya. But most importantly is the fact that we have noticed a lot of our clients are really inclined and have a lot of common values as far as working with Knight Frank is concerned. We believe they're a partner that will be able to unlock value for most clients, whether you're looking to purchase a house, whether you're looking for a rental, whether you're looking to invest in the real estate market. We think that Knight Frank fits the bill as far as that partnership is concerned. In terms of how we'll go through the session, I'll invite Ben Woodhams, who's the MD of Knight Frank. He'll take us through the detail of what trends they are seeing on their side. Then Ben will open up with a panel where we'll discuss some of the details around what areas do we think are growing. John will tell us what are the products that we think would be relevant to you and some of the challenges that are happening in the real estate market now. And then we'll go into a Q&A where the questions that you type in will be answered by the panel. Then after that, we will pick any other questions that might be there, do a small survey, and then we can close. So it's a very tight schedule, but very interesting, quite engaging. We have the experts here. Ben has over 26 years in the real estate market. Goss has over 10 years as well, and Charles has over 10 years experience in research in real estate. John Kaburu here has over 20 years experience within ABSA Bank, and he's currently running our mortgage strategy. He's doing offers for customers. So it's quite a rich panel over 50 years, I might say, experience across the board. So thank you, and please engage as much as possible. Your relationship managers are also online, and they'll be there to support you. If you're having a challenge with the Zoom link, if you'd like a friend of yours to join in, please invite them. And on behalf of Premier Banking, on behalf of ABSA, and on behalf of your relationship managers, we want to wish you a very successful session. We'll catch up later. Thank you.
Good morning and welcome to the Property Market Outlook and Opportunities 2022. Thank you very much, Simon, for those kind words. The run today will be, I'll do this presentation as he says, and then we will have the panel session afterwards where we'll be able to explore some of the issues that arise. This is a very informal session, so we really do encourage you to put as many questions as you can into the questions box, and that'll get the dialogue flowing very nicely. So welcome to the ABSA customers and welcome to my panelists here as well. So what I'm going to do today is talk you through the property market outlook, touching on the economy, property market activity, global perspective, and then we'll look at the state of the residential market in particular, something we want to focus on today, particularly with the mortgage aspect that we'll be focusing on, talking about the mortgage market itself, prime residential trends, and looking at affordable housing, yields in terms of investment opportunities for you, and the outlook going forwards. So, just a little bit about Knight Frank first. You saw that very quick introductory video of ours. We have in Africa 21 offices in 9 countries, 655 people working on the continent. These are real offices. They're not just representations or dots in the map. We have big teams in each of those 9 countries. And from those 9 countries, we have worked in all but 3 countries in Africa over the last 18 months. So we really do have excellent and unparalleled coverage of the continent to serve you and your needs. Our services, what we do as Knight Frank, a multidisciplinary real estate consultancy, the core services are property management, both residential and commercial, agency, and valuations. The additional services we do, development and consultancy, that's helping you make strategic decisions in relation to property, capital markets, the purchase and sale of commercial property, as well as, of course, the residential side, and retail. And tertiary sectors, which we're going to talk a little bit more about today, agricultural, healthcare, hospitality, education, and diplomatic. So these are services which are not traditional real estate consultancy services, but are a sign of the times of how the market is changing. So let me start by looking at the economy as a whole, looking back as well as looking forwards. You'll see that massive dip there, and of course we all know what that relates to in 2020. We're not going to dwell on COVID today too much. I think we've all talked about that an awful lot. We will obviously touch on how we think it will affect the outlook going forwards, but by and large, you know, we're not going to have a deep dive into the pandemic itself. Population of Kenya, some 53 million people. We have seen a recovery in 2021, and this is as a result of a delay in activity in 2020, but also simply getting the economy coming back. As you can see, Kenya's seen a slight negative GDP in the year 2020, but nothing like as severe as the rest of sub-Saharan Africa, which is represented by the red line, as you can see, takes a dip to below minus 2% GDP. We're seeing a reopening of the economy, but the key economic risks looking forward are currency depreciation, increasing debt levels, of course the elections in 2022. I'm afraid we can't get through today without talking about those. And so we're predicting at least a 2-year recovery to get us back to the levels of pre-pandemic 2019. But however, Kenya does remain a regional hub for most organizations, and that regional growth will drive economic recovery. Macro economy now, looking at rates and exchange rates, depreciating shilling, mainly against the dollar. I mean, you know, we're talking about depreciation, but not catastrophic depreciation. I mean, some of the currencies in the continent of Africa depreciate substantially every year. And I think one of the things that makes Kenya an attractive investment destination is the fact that the Kenyan shilling is actually quite stable. However, we have seen a 10% decrease against the dollar in the last year or so. And so that is making giving challenges. Tenants paying rent in dollars are obviously, that just translates as a rental increase unless their business is completely dollar denominated, and relatively few of them are. It's making international investment more expensive as the value of your home currency decreases, so the cost of investing overseas as well as buying goods from overseas increases commensurately. Lower interest rates and inflation rates, cost of borrowing is going down, which is good news, but it is still very high, particularly on the international, in comparison to the international stage. Inflation is creeping up, which means purchasers' capacity is reducing. Possible hedges against the depreciation of the Kenyan shilling, investing in dollar-denominated assets in Kenya, although there is a scarcity of true dollar-denominated investments. Many of the dollar-denominated investments that we see here actually are shilling investments, whereby for instance, in the case of property, whereby the tenant paying rent in dollars actually got a shilling income, and so they're having to buy the dollars to pay their rent. So really the risk of them defaulting is still relatively high, because as the shilling depreciates, so as I said before, their rental level goes up. So the risk is still there. And of course you can, as I say, invest overseas, and Knight Frank can help you do that. As an indication of a market recovery, we're seeing property transfers increase. So between 2019 and 2020, we saw a 10% decrease in property transfers at the Ministry of Lands. Between September 2020 to September 2021, we saw a 35% increase. So we're starting to see transactions increase significantly, and that's great news. This is as a result of lifting restrictions, particularly the COVID restrictions that were dampening the market down, and buyers taking advantage of the market as vendors are coming to terms with the fact that they're having to reduce their prices in order to get transactions to happen, in order to sell their property. So we have, across some sectors, witnessed declines of in excess of 20% of asking prices, and we'll touch on that a little bit later as well. But that's a sign that, as I say, vendors are becoming more realistic about their expectations, and purchasers are taking advantage of those decrease in prices. So is this increase in property transfers a spillover of pent-up demand from a time where people were simply not making strategic decisions during the peak of the pandemic, the latter half of 2020 and the early part of 2021? Or is it a genuine sign of the market recovering? I mean, that's a very difficult question to answer. Perhaps it's something that we can address in the panel, but I think I would say it's probably a bit of both, to be quite honest with you. And we're seeing other signs of recovery, particularly, for example, in office leasing. So there are opportunities for reasonably priced and discounted properties out there, and we need to explore exactly where they are. But just before we get into that, just for a little bit of fun, to give you an idea of price comparisons around the world. This was taken from the 2021 Wealth Report. The 2022 Wealth Report is going to be launched early next month. And this Price Pagoda, as we call it, Price Index Pagoda, is in every wealth report. And it basically tells you how many square meters $1 million buys you across the world, ranging from 636 square meters. This is for prime residential property. 636 square meters in Nairobi. Cape Town, 174. So already a massive difference between the cost of prime in Nairobi and Cape Town. But that $1 million will only get you, let's have a look. Miami will only get you 81 square meters. In Monaco, it'll only get you 16. I don't think that's even a bathroom. So you go from 636 square meters in Nairobi to 16 square meters in Monaco. So perhaps Nairobi isn't such a bad place to invest after all. This is a fascinating graph. Home ownership in Kenya. And I think we can perhaps challenge the bank on this. This can come up in the Q&A, but it talks of what I would call the rent trap, really. And this graph is a comparison between those of us who own and those of us who rent our property. The difference is in Kenya as a whole, 61% own, 39% rent. But then the differences become more stark as you look at other sectors. So rural, 87% are owned, and only 13% of people rent property in rural areas. In urban areas, that reverses. 21% of people, only 21% own their own homes, and 79% of people rent. But look at Nairobi. Only 9% of people own their own property in Nairobi, and 91% people are renting in Nairobi. And why is that? And I think, as I say, this is what I call the rent trap. And basically what it is property is extremely expensive in urban centres, especially Nairobi. And the cost of borrowing, although it's coming down slightly, is still very high. Servicing mortgages is significantly more expensive than paying rent, and that's a challenge that we need to address if we are to get more people onto the property ladder, more people participating in the economic growth of the city in which they live. I think that's a very important issue to address. I know it's part of the government's Big Four agenda, and I think it is one that we're going to be talking about a lot more in the future. Looking specifically now at the residential market, the amount of mortgages in Kenya is tiny, and the total number is actually dropping. So, we got to a peak of 28,000 mortgages in 2019. 2020 saw a reduction, but even 2016 saw a reduction against 2015. So we're really not getting this right. And I think, ABSA is championing the reduction of mortgage rates and being more creative in their mortgage offers, and we can talk a little bit more about that in the panel session. But it is quite astonishing to see that is such a small number and actually not really growing either. The average mortgage rate of 10.9% is the lowest it's ever been at the moment. We'll talk about whether ABSA can match or reduce that, but it's still very high. I mean, I have a mortgage for a property in the UK, and it's at 3.5%, and that's considered high because it's a buy-to-let, it's an investment. So if I'm paying 3.5% on an investment property in the UK, obviously the circumstances are very different, but it just goes to show you that there are massive challenges which need to be overcome, both in terms of the cost of borrowing and in terms of the other challenges, the inhibitors that prevent you from getting onto that bottom ladder. So we're seeing a drop in residential sales and rental prices. Some prime properties are increasing over that time period. I mean, when you get to a certain level of wealth, you're less sensitive to temporary economic fluctuations. But generally speaking, we're seeing a drop. We're seeing an increase in investment in affordable housing and in student housing as well. And we'll talk about that a little bit more as well. Housing deficit of circa 2 million units at the moment. Affordable housing remained and will continue to be a key trend in 2021, as I've said, a very important issue for the current government. Looking at the prime residential market, okay, so here, the picture looks a bit rosier, but don't forget, we're looking at the very top of the market here. Limited opportunity in the prime residential market because of high capital prices and oversupply. Sales and rental prices recovering slightly after the reopening of the economy and the vaccination rollout. So seeing that the whole market open up. We've also seen market activity, people wanting to move out of densely populated areas like the heart of Nairobi into suburban areas like Karen and Runda, and that's driven the market at the top end. And also people wanting second homes to escape the effects of the pandemic. So we've seen an increase in demand for properties at the coast, for example. So looking slightly more further down, the affordable housing, as I said, part of the government's Big Four agenda, 500,000 houses targeted by the end of 2022. Well, we're well into 2022 now. We have 2,235 houses that have been developed under this project. We have another 37,000 currently being developed. We have another 384,000 units under evaluation, so they haven't even started yet. And we have 142,000 units planned. So, as you can see, we've got a target of 500,000, and we've got under 2,500 so far, with a likelihood possibly of adding another 37,000 during the course of this year. So we're a long way behind our target. There is a lot of noise, a lot of buzz about affordable housing. A lot of organisations are contacting us about purchasing land, particularly on the outskirts of Nairobi and beyond, Athi River and so on and so forth. So there is definitely movement, but we are a long way behind our original targets. Okay, This is an interesting chart. I want to spend a little bit of time on this. This is talking about yields, the returns on your investment, and comparing residential property with other sectors. And really, we've only said office, retail, and logistics here, but there, as I mentioned at the beginning, many more sectors than this. Why are returns on residential property so low? Well, a standalone residential property is an extremely inefficient investment. If you compare a standalone house with a block of apartments, this is really just about economies of scale. So you have one watchman for a house. You might have one watchman for a block of apartments. You have one generator for a house, and yet you have one generator for a block of apartments. You can see where I'm going here. So the costs associated with running a single dwelling are high simply because of the economies of scale. But residential property, even at scale, in high density, is still only giving you 6 to 7%. So it's the lowest of the other investments that we have there. And why is that? And it's partly historically because the costs of running that investment are not always passed on directly to the tenants. So in an office environment where you have a service charge, where you have a full recovery, so in other words, your tenant pays his rent to his landlord, he pays his service charge to Knight Frank in most cases, although other managers are available, there's not very many of them. And so you get the full cost of that property, running that property back from the tenants, and that's not the case in residential. So that does give you a differential. But there's a very important thing to remember, and that is capital appreciation. Capital appreciation in residential property can be stratospheric. You can get, I mean, if you were to have bought a house, let's say, for instance, a house on 5 acres in Carron in 2005, you might have paid 50 million shillings for it. Today, that property would be worth 250 million shillings. So my advice would be, if you're looking at residential property as an investment, you have to invest in an area where you believe there will be future growth. That is not Carron, that is not Runda. It is going to be other places, and we can help you find those places. But there is an element of risk, and high return is associated with high risk. So you want to be looking at areas, and one of the examples of residential property that I'm going to show you in a minute might just be one of those areas. But when I say might just be, there has to be a degree of speculation there. None of this is guaranteed. So we'll talk about that. But the key to investing in residential property is not the yield, in other words, the relationship between the rent and the capital value. It's about the capital appreciation. That's where the opportunities lie. So taking a slightly a step backwards and looking at sectors across the market as a whole before we go into a slightly deeper dive into residential. The hardest hit sectors during the pandemic. So this chart here tells you pre-pandemic what was happening during the pandemic or now as we start to come out of it, and longer term prospects. So as you can see at Knight Frank, we're extremely optimistic about the long term. There's no red dots in there at all. And being optimistic is all part of selling property. So that's where we come in. The hardest hit sectors, hospitality, regional, the big shopping centres, the big hotels were hit very hard during COVID. Interestingly, so were the serviced offices. They were hit quite hard as well because of the flexibility, enabling those tenants to simply walk away from their obligations. And that's a very interesting topic, which I want to come back to. So the niche differentiation in sectors such as office spaces and residential is also critical. So offices as a whole and serviced offices. If you're a landlord, you'll have an office occupier and that your standard tenant, and as far as you're concerned, your serviced office provider is a normal tenant. But for the serviced office provider himself, his income is determined by how many people he's got occupying that space. And his leases are very short, licenses, I should say. And so when the pandemic started, all the occupiers of serviced offices could simply just walk away from their obligations, go and work from home. I don't need this office anymore, I'm cancelling my license. And so they were hit very hard. But now the shoe is on the other foot, because as we come back into reoccupying the office space, people want that flexibility. They want to be able to rent meeting rooms by the hour. They want to be able to work from home on Fridays. And so the serviced office occupier is able to provide that flexibility. And so what that has meant is that we've seen a huge demand take up from serviced office providers. And we will continue to see that because that flexibility has become very important. In Nairobi, an office occupier generally has a 6-year lease. So what that means is that it's very slow for the impact to be felt for any changes in the market. Not so for serviced office occupiers. So it's an interesting, you can look at niches within sectors to see differences. So offices isn't just a single story. Then we look down the chart, prime residential, we've seen, we're forecasting a recovery there. Affordable housing was strong all the way through. Logistics was also strong all the way through. Not so much, not in the same way that the rest of the world was, where online shopping absolutely took off during the pandemic when people weren't able to go to the shops, but also to a fairly strong extent here in Kenya as well. Data centers, agriculture, healthcare obviously for obvious reasons, strong all the way through the pandemic. So, looking at some more specific investment opportunities. Here we have a 3-bedroom house with a guest cottage on Bagathi Ridge, under offer for 95 million. So that's a shade under $1 million. Well, about, I don't know what that is, 85 to 90 million, sorry, 850 to $900,000, something like that. This is our area of specialization, where we have a high track record of high-end property. Again, this would not be a great investment if you were looking for a yield. But if you're looking for a family home, which you would hope would appreciate in the future, then yes, not a bad investment. And not a bad investment for 2 reasons. One is because it's an investment that you get to use and enjoy whilst you're in it as well. But another, although I would say that Karen has probably reached the peak of its appreciation in terms of growth in comparison to the rest of Nairobi, it will still appreciate as the whole of the city appreciates over time. Now this is more interesting in a way because you're looking here at a large number of residential properties that are built in what is very likely to be an area that is up and coming. You can all read the screen. You all know where Garden City is, up Thika Road. This was a development done by Actis and in conjunction as a joint venture with a residential development company. And we see here, Tarquin can tell us a little bit more about this perhaps in a minute, but this is, I think, probably about 60% purchased by investors and 40% by owner-occupiers, something like that. So we're starting to see people coming in, buy speculatively for a return, but also for capital appreciation. So they are hoping that these properties will grow in value because they're in an area of Nairobi which is growing. And I think that's the key, really. The ranking, as it were, 55 million. You can't really say it's more affordable because 55 million is still a lot of money. But however, these are opportunities that present themselves as something that's slightly more affordable and something that, again, might give us an opportunity for future growth. So there's 3 examples there. There are others as well, excuse me, there are others as well, which we'll talk about during the panel session as we explore how best to invest your money in order to get a return, both in terms of yield and in terms, as I say, of capital appreciation. So that brings me to the end of my presentation. This is a sample of the kind of publications that we produce, which are available from us. Most of these are produced by Charles, who I'll introduce you to shortly, who's we're very fortunate to have with us today, and talk about the numbers behind the facts. And these numbers are the data that help you as investors make those strategic decisions in order to safeguard and enhance your wealth for your own income now, and to safeguard the income and financial security of your future generations. So I will move now over to our panel session. Thank you very much for listening to that. I see we have had some questions coming in as I've been talking, which is great. So we'll move on to that now and get those questions answered. Thank you very much.
Hi, my name is Paul Maundu and I'm a residential agent with Knight Frank.
My name is Sasha Horner from Knight Frank, Kenya.
Hello, my name is Dion Bernard. I'm a residential agent for Knight Frank, Kenya.
Hi, I'm Brenda Ngigi with Knight Frank, Kenya, working as a residential agent in Karen.
Hello, my name is Nikita Fazal and I work as a real estate residential property agent for Knight Frank, Kenya.
Hi, I'm Jane Mugambi from Knight Frank, Kenya, and I've been in the residential property market for 21 years.
Welcome back, and here we are with our panel to talk about the outlook on the residential property market. And I have with me today John Kaburu, who is the head of mortgages at ABSA, Tarquin Gross, the head of residential from Knight Frank, and Charles Macharia, the head of research at Knight Frank, Kenya. Welcome to my panelists. Thank you very much for joining us today. So we have a number of questions that have come through from the customers of ABSA while I was talking, and also I have some questions here myself which I would like to ask the panel too. First question, I think, John, if I can start with you. As head of mortgages, how does ABSA support clients who are looking to invest in the kind of product that we've been talking about today?
Thank you, Ben. ABSA has taken a position to fulfill the dreams of our customers, ranging from first-time buyers, going into second property, that is through investment, and we have solutions there. So if I would summarize the key things that we give at ABSA from a home loan or a mortgage or a property perspective, we give you financial and non-financial options. From a financial perspective, there is your relationship manager who will walk with you on your financial planning and where the investment fits and what gaps you see in terms of financing. They'll advise you on how we can bridge that gap. The other options that we have are actually the partnerships that we offer with our customers. Firstly is this session that we're having is among the things that we've lined up. But we've also partnered with other real estate players, the developers, the marketers, and we provide these options on our website where if you wanted to look for a property, you can go in there and get some options there. The other thing we offer is the Mortgage Center expertise, where we have a fulfillment team that helps you walk through the journey of mortgages. If you are looking to acquire, we have a legal team that supports us with that and makes the process easy for you. But finally, we have also options from, if you are looking to buy a property, we can give you very long-term loans. Our longest term is on 25 years when you're looking to buy. If you're building your own house, we do up to 20 years. And we finance 100% of the construction cost. There's also an option where you can use your current home. We give you 80% of the current market value, and you can use that money to go and do additional investments, whether it's another property or any other investment that you want to do. The other option under that is we give you a conventional loan, but we also have the option to go through Lariba Banking, which talks to those who don't want to incur interest, but we go through the profit-sharing option. So for our Muslim customers, our Lariba option is very, very competitive, and that gives you additional choices. The third option under the offering we have is the currencies that we give you, we can start with Kenya shillings, but there is also for those who earn in foreign exchange, and I think Ben brought that out during the presentation, that with the current fluctuations in the foreign currency market, how do you guard your investment? So if you are earning in dollars, we can give you a loan in dollars, very, very competitive rates. So we also have for sterling pound and the euro. So those are among the options that we have for our customers. Thank you, Ben.
So 25 years, is that longer term than most banks would offer? I mean, you know, you hear of 10-year mortgages, 15-year mortgages. The ability to stretch that repayment period obviously means that your monthly repayments will be reduced, and that's really what we're trying to achieve here, isn't it? So would it be right in saying that 25 years is from ABSA quite a long period in comparison to what other banks are offering?
Exactly, yes. You're spot on there. Our offering in terms of the tenor is one of the longest in the market, and that's across the three options. Where buying, we can do up to 25 years. And as you rightly put it, that means better affordability for you, because you are paying less per month than if your loan tenor was shortened. And I think while still there, I can talk about what we're about to venture in on the affordable housing space. We are shareholders of Kenya Mortgage Refinance Company. We are about to roll out financing under the KMRC offering. And again, we are looking to mirror that long-term loan offering of up to 25 years.
That's fantastic. And I think, you know, there is culturally a resistance to people signing mortgages for these longer periods. And I think that's one of the challenges that we need to overcome here in Kenya. I mean, you know, I've been working for Knight Frank in East Africa for the last 23 years, but I started my career in London, and my first mortgage in London was for a term of 99 years. And you know, I think that would terrify people here to sign, you know, a contract that clearly will outlive them. But I don't think that that's the point. The point is that if you stretch the term out long enough, you can make the monthly repayments more affordable. And ultimately, when you sell the property, you pay the mortgage off. You don't have to you hope that you live till 140 so that you can pay off this loan. I mean, that's not really how it works. So I think it's really important that people understand that, and also understand that the offering that is from ABSA at 25 years is brilliant. It's certainly a move in the right direction to make mortgages more affordable for people. And I think, you know, this is something that's passionate to me, getting people onto that property ladder. It's really important. If you're paying rent, you're simply paying money away to your landlord, and your landlord is getting the benefit. So if you think of being a tenant in Nairobi, you are, if you're a property owner and your property is appreciating in value, you're participating in the growth of the city in which you live. You're a part of it. You're a stakeholder in Nairobi's economic growth. If you're paying rent, you're simply making someone else benefit from Nairobi's economic growth. And that's why it's disappointing for me to see that there's so few mortgages. There's so few people who are taking advantage of this. But of course, I do understand that you know, mortgages are not for everybody, but I do think we need to get more people onto that property ladder.
Ben, if I may add a bit, also on why you can go for the long-term loan. We also sweeten it a bit for our customers that we do not charge you for early repayments. So if you took a loan for 25 years, it doesn't mean that you have to pay that loan in 25 years. Once in a while, there will be windfall money that may come your way. You may get some bonus or some other money that you can pump into the loan. And because the loan is on a reducing balance basis, what that does is it saves you interest, but it also shortens the loan term that you're looking at.
So those lump sum payments would go into the repayment of the capital rather than the interest itself?
The interest is on a reducing balance basis, so the moment you make an early repayment, you can have the option of loading it directly into the capital.
Makes sense, and very, very good point. Okay, so we're in danger of focusing too much on John and neglecting our other panelists here, although I think that drilling down into the mortgage aspects is really what it's all about today. So I'm going to ask another question which has come through from the customers, and I'll start with Charles, but I suspect that John might also have a comment to make on this one as well. So on the residential mortgage data, how do you explain the drop in the number of mortgages between 2019 and 2020?
Thank you, Ben. Thank you, Ben, for that. 2020 was when the pandemic began, and maybe John can talk more about it in terms of from a financial lending perspective, but information from the central bank is that because of the uncertainty, financial institutions were not in a position to lend to their clients. So that uncertainty meant that various financial institutions were holding on to their various lending requirements just to see how the pandemic would play out. But we've seen that 2021, based on the information and the graph that you've just shown, that transactions are happening. So we are hopeful that lending will progress, and as well as the government has put in place the Kenya Mortgage Refinance Corporation that has disbursed funds, as John has explained, and ABSA is a participant of that, and hopefully that would spur more lending. The results in terms of lending for 2021 are not yet out, but we expect greater lending in 2021 moving forward. John?
Thank you. I would attribute it to two perspectives. The first one, remember, there is the natural attrition of loans. So if you have X number of mortgages in the country and you're not adding new mortgages,
people are paying them off.
People are paying them off. Obviously, that will indicate a drop. The second bit is now the reality when COVID struck, where you are in the middle of a mortgage process, but you've lost your job. That mortgage will not come through. So those two combined obviously was going to reflect on a drop in the mortgage accounts number for the country. Yeah. Okay,
thank you. So Tarquin, we've touched on 3 examples of the kind of product that we at Knight Frank have to offer people. You know, I've touched on which aspects are perhaps more suitable to investors as opposed to owner-occupiers. Do you want to expand slightly on the kind of product that we have and what different aspects of it would make those products of interest to investors in the sector?
Thank you, Ben. Good morning. Yeah, I think at Knight Frank we try and cater for everyone or a wide range. High net worth individuals, prime residential is probably our, what I'd say, bread and butter, where we get a huge amount of our listings. But as Ben said, you know, and obviously today, it's about looking at other opportunities or other investments that might be of interest. And I think that's where we've sort of tried to expand a little bit. Going to one of the 3 examples, MyVida Homes, you know, that is middle to low income homes, and the look on that is more that your yields are hugely, not only from a rental perspective, but the rental yields year on year, we're coming out between sort of 7 and 9%, which is a lot better than most residential properties. But also the fact that, as Ben, you touched upon, the capital appreciation, Nairobi is growing so fast, and homes slightly further afield are going to become more and more desirable, and in doing so, when we've got greater demand, that will increase our capital appreciation. So MyVida, for example, we see good growth, and I see, you know, from a rental perspective, if you can slightly higher volume, if you can, you know, own 2 or 3, then your opportunity to, you know, capital appreciation, but also not have all your eggs in one basket, give you a range or a difference is a benefit. But also, you know, we haven't given up on our prime sales. You know, Imbagathi Ridge is a great example. We've also just agreed this week another one in Tate Close, Kitsuru, which are predominantly prime residential, but sellers who are looking to move in the market, desires to, specifically Imbagathi, where a seller's got a plan to do future investments in property, and so are looking to actually get the property sold, listing at a good price. Both properties sold within 2 months in a market that we've been unsure or uncertain about. It gives me a lot of confidence that even in our prime areas, if sellers are willing to be slightly more realistic, there are buyers, and so I see good opportunities from prime to affordable to investment opportunities. It looks like a very good outlook for the first 6 months of 2022.
Okay, thank you. I think that's an important point to note that, as I mentioned in my presentation, there was a time a few years ago where vendors had unrealistic expectations as to what their properties were worth, and that made it very difficult for companies like Knight Frank to manage those expectations, really. And I think that we're seeing now that vendors are being slightly more realistic, listening to advice a little bit better, which is giving buyers an opportunity not to get properties at a steal necessarily, but to purchase a property at a more realistic price.
No, and I might add to that, Ben, that what we have seen and is actually sellers, although have a listing price, are open to discussions, and so I'd encourage those looking in the residential market to be optimistic, to give offers, because I think that there is discussions to be had. But sellers, from a selling point of view, which some of you might be, you can't. Once you reduce your price, you can't put it back up. But sellers are open to discussions. So from a buyer's perspective, it's important to start a discussion, to put it out there. And I think in the chat, you'll see a downloadable brochure for all listings, or a number of our listings that we have available at the moment. So I'd encourage you to have a look through. If anything is of interest, please reach out to me or my team, because there's definitely opportunity there.
Okay, Charles, a quick one for you here. What are the pros and cons of PPP instruments, private-public partnerships, lending on property development as an alternative to property development? So I guess what this question is asking is participating with the public sector as a property investment rather than simply the private sector in isolation.
Thank you, Ben. With regard to PPE types of arrangements, number one, with regards to pros, there are quite a number of pros in terms of there are quite a number of opportunities in the real estate market that the private sector can just not engage on, be it because of the bureaucracies involved with the government. There are various aspects such as the healthcare sector, the infrastructure sector, the education sector. So there are opportunities based on the African demographic in terms of as there's a shortfall. For example, in the infrastructure sector, there's a shortfall of infrastructure projects in terms of accessibility, and the government cannot execute it on its own. Therefore, there's improved opportunity in terms of delivering such projects. The cons, obviously, is the deliverables, the bureaucracies involved with dealing with the government. There are very few institutions or players in the market that have successfully partnered with the government and come out profitable. But we are seeing more and more of that being overcome, specifically by foreign players. And if they're able to overcome the bureaucracies, there are opportunities based on the alternative real estate classes.
I think that's absolutely right, Charles. And I think another thing to bear in mind is that, when we're looking at affordable housing, for example, it's very difficult for the private sector to develop affordable housing, it's called affordable for a very good reason, and that is that it's cheap. And therefore, it's very difficult for a private sector developer to actually get a return on their investment building property when it's very cheap. And so, of course, this is where PPP partnerships with the public sector become very important, because various parts of the equation can be adjusted by government to make that development more affordable, to increase the profit margin for the developer. And that might be giving the land, for example, or guaranteeing offtake, so that the risk is reduced for the developer, because they know that at a certain date, once they've achieved their objectives, the units will be purchased by government or a parastatal organisation or some other organisation at a fixed price in the future. And so that takes the risk out of the development. There can be tax incentives as well. But this is all, in answer to that question, this is how partnerships with the state or the government can make achieving those objectives more financially viable for the developer and more viable full stop for government when we're trying to achieve those targets that they've set themselves in terms of the production of affordable housing units. Right, I think it's important that we address the difficult questions today as well to respect the customers of the bank. And I think a question which I'm seeing coming up on here is why are the lending rates so high? And you know, forgive me for mentioning what they are in other parts of the world, because that does illustrate a glaring difference between this region or the continent as a whole and other parts of the world where we're seeing extremely low interest rates, or not just on mortgages, but also, to be fair, on deposits as well. So it's a double-edged sword. But going back to that question, I think perhaps, John, this is one for you. And I'm not talking about ABSA in particular. I'm talking about generally, you know, interest rates in Africa, generally in Kenya specifically. You know, we're double-digit interest rates. Why are they so high? And another question is, you know, what can we do in partnership to try and reduce those rates?
Thank you, Ben. I'll start off by noting that interest rates that banks charge in the country will be reflecting the general interest rates in the market. You cannot isolate.
Don't worry, we're not blaming the banks.
Exactly. Yeah, so that if you looked at what are the current trending interest rates on long-term savings, and the truest indicator is on government bonds. If you went to the central bank for a long-term bond of more than 10 years, you're looking at an interest rate of more than 12%, which then means you can take that as your cost of funds that you're borrowing, because you're competing with savers for that rate, and then your lending will start from there. So if you then started with the indicative government treasury rates as the cost of funds, then it means your mortgages will start from there. So there's a question of that the cost of funds tend to be higher in the long term in the market, and that then starts dictating higher rates on the mortgages. The second bit is the inflation rates that we face in the country. Last year, I think we're closing at 6.91, above 5, which then means if you go to the Western countries, the inflation rates will be lower. So you're not likely to be lending lower than the inflation rates that are at play. So those two things combined, then they dictate higher mortgage rates. But what is the solution around it? The first one is what we have come back to do in terms of can we introduce an element of other currencies being at play so that the current interest rates on foreign currency rates and loans is lower than the Kenya shillings. The second bit is the tenor play. If we can support you for the longer term, that may be a bit more affordable. And as I said earlier, we also leave the window open for you to fast-track the payments so that you don't literally incur the actual interest over the loan term. So those are the two aspects I would bring.
I suppose a question coming out from that, and this might be considered to be slightly facetious, is if banks can get a return of 12% on government bonds with zero risk, why do they lend to the private sector at all?
Let's come back to our purpose as Absa Bank. If I would say, I would talk on behalf of Absa. Our purpose is to bring possibilities to life. So it's not all about profit. There's also the question of how we working with our customers in their financial journey. It's a relationship we have. It's not profit driven. So we can participate with the customer to help them own their homes or do their investments, as long as on the overall, the relationship is beneficial to both of us.
But it's interesting to note, though, that the rate at which the government is paying back lenders on government bonds does prevent a challenge in the market, because it is very, very high, isn't it?
And there's an opportunity. Remember, even as a bank, you diversify even your investments. You may not go 100% on one asset class. So the diversification element also comes into play, besides the purpose of supporting your customers in their financial journey.
Thank you. Now, this is a slightly difficult question, so I'm going to choose Tarquin to answer it. Ben, you mentioned that you estimated 2-year recovery to get the pre-pandemic rates. No, hang on, sorry, it wasn't that question I wanted for Tarquin. It was about, let me see if I can find it. Oh, yes. What are Knight Frank and other agents doing to improve the efficiency of the lands registry? These are not my words, okay? This is the words of one of the ABSA's customers, and this is Chatham House rules, although this is going out on YouTube, so that may be a challenge. But what are Knight Frank and other agents doing to improve the efficiency of the lands registry, which currently is so corrupt and unpredictable? Do you see any improvement in the new online system?
Challenge indeed. Difficult to say in terms of what we foresee with the new online system in the Lands Department. I think it can only be an improvement, is the first I'd say. I think that change takes time, and we have to give it a chance. And I think that in the long run, it can be to our benefit. I think it's probably a question more could be better towards your lawyers or the legal teams, because they're the ones who are sort of on the front line and the ones that would be the one who've been dealing with the Lands Department on a day-to-day, because when we're purchasing or whatever. But I think from an agency point of view, I think it's got to be a benefit. I think that it will cut down or should help with the corruption side. It should help security on our title deeds. And in general, I think that something had to change. You know, at the moment, you know, like Ben was saying a bit about the UK mortgage rates, you know, I did a lot of experience in the UK, and typically we'd say that a sale should be conducted within 3 months. So from the point of listing to the point of completion, 3 months, which is unheard of in Kenya. And at the moment, we're looking at a time frame between six months to a year for completion. Obviously, that's elongated because of the current problems with the Lands Department. But I think that we have to make that shorter. You know, we need volume of transactions in the residential sector. And if this new online system could make inroads into that and make time frames shorter, I think it can only be a benefit.
I mean, are you seeing signs of that? Are there some properties that are coming through the new system now? Is that evident?
Yeah, definitely. We've started seeing, you know, well, in 2021, 2021, obviously COVID was a big impact, but also the Lands Department. In many ways, it was kind of like, you know, with COVID, it was a blessing in disguise that the Lands Department were doing it at the same time, because obviously the volume was down. But as we've come into 2022, we are seeing a lot of these title deeds that we were waiting for, or for completion to be able to be, you know, for completion to take place. We've been waiting on the Lands Department, but we have seen a number of them come through recently. And I think, you know, the lawyers I speak to, I think that we are starting to see things start flowing through again.
Thank you. Now, I'm getting a number of questions that are quite technical about mortgage offerings and the restrictions and so on and so forth. And I've been told that those specific questions will be answered on the chat because they get into the slightly more technical details. So please don't think I'm ignoring you if you've asked one of those questions, but they will definitely be addressed on the chat. And if we have time, we'll come back to those and explore them specifically. Right, another question here. Let me see what we've got. Ben, you mentioned that you estimate a 2-year recovery to get to the pre-pandemic rates for sale of property. Do you anticipate the property value for residential and commercial property to increase after that, or had we reached the bubble in 2019? Now, I love talking about the property bubble because it doesn't exist. And you know, a lot of people say, is the property market going to collapse? Is the bubble going to burst? Are we going to see a price crash? And I think, you know, if we go back in time to 2007, 2008, to the global financial crisis, where we saw a collapse of the property market as basically one of the aspects of the global financial crisis, it's interesting to look at what caused that and what were the ingredients for that to happen. And I think the fundamental reason was there was a huge amount of borrowing. And as I've just said, there is only a tiny amount of borrowing that's actually going on in Kenya. And let me explain why that's an important factor. So if you have house A, house B, house C in a row, and house A and house C have 90% mortgages, or let's say 50% mortgages to keep the math simple, and both of those, the occupier of house A and C default on their mortgage, then the banks will need to sell those properties. And so if house A and house C are sold at, let's say, 75% of their true value, I'm being careful not to paint the banks in a bad picture here, but obviously in a crisis in America where the banks had huge amounts of property that they had to offload, maybe they were only interested in recovering the amount of money that was owed to them, i.e. 50% of the value of that property. My point is that the chap in house B, who was minding his own business, owned the house outright, didn't have a loan on it, when house A and C were sold at 50% of their value, guess what his house was worth? 50%. All of a sudden, overnight, because a large amount of property is being dumped on the market. I'm being very simplistic to make the point, but the bubble bursts when a lot of people lose their jobs and cannot serve their mortgages, and that property is dumped on the market. And we don't have the ingredients here for that. We certainly have the ingredients for a price correction. Even when you say there's an oversupply of property in the market, whether it's apartments in Kilimani or whatever, that may well be true, but not to the extent where we're going to see a massive collapse in that market or that bubble bursting. So we've definitely seen a price correction. As we've talked about, we've seen vendors adjust their expectations and reduce their prices, but that might be 15%, 20%, and 20% might represent their entire profit margin. And so some of those developers might go bust. But again, not to the extent to create a massive collapse. I mean, I'm no economist. I'm speaking in somewhat anecdotal terms. I don't know, Charles, if you'd like to add anything to that? Being a bit more of an economist than I am anyway.
Thank you, Ben. Yes, there is no property bubble. As Ben has, excuse me, as Ben has indicated, the number of outstanding mortgage accounts are 26,000, odd on 26,000 as of 2020. The number of land transactions in Nairobi alone was at odd 2,000 for a single year. So that's just a tip of the iceberg of the property market. So in relation to that, there's no property bubble, but maybe just a price correction. We are seeing and that's from the asking prices, not as per the market values. The asking prices can be as high as 20, 30% over and above the market values. But if you're looking to sell your property, we would recommend that you get a market valuation of the property as at that particular time, so you know the market value, so that you're not having unrealistic expectations when you're selling your property. So yeah, thank you.
Okay, thank you. So I said earlier that I wouldn't go into technical questions relating to mortgages, but this one is quite interesting because it's something that I don't know the answer to. And it's a question from one of the ABSA customers. Do long-term tenure mortgages have certain conditions, e.g. retirement age? So in other words, if I'm 10 years away from retirement, would I be able to take out a 25-year mortgage?
Thank you. Yes, there will be a limitation, not specifically to retirement age, but to ability to pay.
So it would be on the onus of the customer to demonstrate that they would have an income for the entire 25 years.
If you go back to the example you said about the crisis we had, the economic crisis around properties, there was also the question of no income, but you would get a mortgage because that time you would always get a mortgage because property prices were always going up. Yeah? So as ABSA being a responsible lender, we look at your ability to service the loan. So the question is, after 65, how will the repayments look like? And the beauty of it, the offering is not restricted to personal customers on salary. We also consider other incomes that you could be having. We cater mortgages for self-employed customers, and we also look at your rental income as part of the income that we can use to service the mortgage. So the 65 can come in if you cannot demonstrate that you're able to pay beyond the retirement age.
Okay, fine. That makes a lot of sense. So if you simply have a job contract which says you will retire at the age of 55, that's not the end of the story. You're simply, the onus is on you as a customer to demonstrate what your income stream will look like beyond that point. Thank you. Okay, Charles, one for you here. How can one get information? By the way, this sounds like it was written by Knight Frank, and I promise you it wasn't. It's come from one of the ABSA customers. How can one get information about the average value of properties, land and apartments in various areas in Nairobi without having to consult a valuer each time I need to explore or purchase? In other words, is there a market publication with such information?
Thank you for that question. Yes. As we are all aware, the property market, information with regard to the property market, it's an opaque market, right? So as much as with very little activity and very little transparency. So we would have to recommend that you get in touch with either a registered practicing valuer or a registered estate agent to provide you with such type of information. And not only that, they have to be an experienced professional to give you such type of information, because some information out there can be very anecdotal, like property prices in Upper Hill per acre are, let's say for the sake of argument, 500, 600 million per acre. Now, those you have to interrogate that type of information much deeper. Was it a special buyer? What was the size of the property? Various property characteristics. And that can all be done by a qualified professional. So the answer to your question is no. Currently, there is no public information for such type of there's no public information for such type of data. But at Knight Frank, we are lucky to have been in the market for 28 odd years and have the requisite experience.
We have a team of brokers who are happy to talk to you and to give you some advice on the basis that, if this is your budget, this is the kind of property that you'll be looking for, and to help you through that journey. And of course, with ABSA as your financial partner and the lending options that are available to you, I'm sure between the two of us, we can make your dreams come true. Right, what else have we got here? There's quite a number of office properties coming up in Nairobi. How is demand matching to this growth, and how are prices responding for both buying and rental? That's an interesting question. I think the office market is one that's very close to our heart. The management of commercial property is our core business, and I think whilst it does look like there is a lot of property coming onto the market, okay, we do have some tall poppies like the Global Trade Centre, which is being developed by AVIC as some over 500,000 square feet of office space on Chiroma Road. Having said that, there isn't a huge amount of property coming onto the market, and demand for office space in Nairobi in particular has always been strong. Nairobi is a regional hub, and so we see big global Fortune 500 companies wanting regional headquarters here, and so there is always a demand for office space, and that will continue. So I foresee we're starting to see rents increase again, rental prices around the $20 to $40 level, and I think that is an indicator that the relationship between demand and supply is beginning to shift. So when we start seeing rental prices start to creep up even incrementally, what that means is there's less choice for the tenants, and so they are having to start to pay a slightly higher rate. Right, what else do we have here? One for you, Tarquin. We're approaching the end of our time. We've time for a couple more questions. What's your outlook for second home investment on the north coast of Kenya, especially Vipingo Ridge Estate, Vipingo Beach Estate? Initially, someone's got some aspirations for a holiday home here, clearly. Initially to be used as a holiday home rental income and eventually as a retirement home. So that's quite a good strategy.
Funnily enough, we've seen a huge amount of inquiries into the coastal properties. Kilifi in particular has seen a large amount of inquiries and quite specifically about land. So people obviously have aspirations to build or to develop. I think also the pandemic, touching on it briefly, has taught us that people can work from home. Health and well-being is something that people are very conscious about. And so we have this beautiful coastline in Kenya, and so a lot of people are thinking maybe, they can split their time or build and develop something on the coast. Vipingo Ridge is a fantastic development, very private, offers huge security, but also great amenities. So from Vipingo, Kilifi, we're seeing, large inquiries, large amounts of opportunities. I think the coastal region is quite an interesting one because it will sort of flux in terms of where people want to go. So, at the moment there's a huge influx into Kilifi, but then as Kilifi prices increase, then people will look further afield, maybe back to Vipingo, maybe back to Malindi or to Watamu. But we are seeing a huge amount of inquiries. I think second home on the coast, especially beachfront, are very valuable and have good rental numbers in terms of holiday homes, but also for places to stay and, to spend quality time with the family. And also now with people being able to work from home, it is an area that people are looking into in much greater detail.
It's an interesting strategy. I mean, okay, forgive me for being slightly romantic, but I like the idea of buying a house at the coast for the rental income now, in the knowledge that at some time in the future you can use it when it's not being rented out, because a lot of the coastal properties are rented out on a fairly short-term basis, and then ultimately you can go and live there permanently in your retirement. John, is it harder to get a financing for a second home than it is for your primary domicile? Is there any kind of differentiation in this market?
Not quite. We are open to supporting customers in that front. In fact, for our premier customers, if you talk to your relationship manager, they'll take you through the process, because we need to understand the kind of investment you're making. But going back to the ability to pay, as long as it's within your affordable range, then it's something we do.
So as long as you can pay, you'll lend money to as many houses as I want to buy.
Now that's a conversation, as we said. Your relationship manager takes you through that. So obviously, if you go to additional properties, what you're likely to see is we may not give you the same option as a first-time buyer, where we can go up to 90% loan-to-value financing.
Thank you very much for that. Okay, right, what have we got here? I think we've probably got time for one last question. Before we close, what product, this is a difficult one, I'm not quite sure who to aim this at. What products or property ownership innovation does Knight Frank have that can contribute to de-risking mortgages for both borrowers and the bank? It's a fascinating question, but I think probably, John, it's one for you rather than Knight Frank. What can you do as a lender, as a borrower, to reduce your risk of suddenly finding yourself in a position where you can't actually meet your mortgage repayments? And I think, in terms of innovation, I'm not really sure there's much that Knight Frank can do other than to make sure that, you're getting good advice in terms of, how much capital, your own capital you should put into it, as opposed to what the bank's offering you. But obviously the bank has mechanisms in place to ensure that their customers don't overstretch themselves and are always able to make those payments.
Right. If I looked at the first option, is the one I said, where we give you an option to go for the longest tenor. That talks to ability to pay and affordability in terms of how much you can afford. The other bit we have done is in terms of loan to value flexibility at 90% for high value properties. Again, that allows us to give customer a bigger loan.
Then the risk would be higher of default if you're borrowing at 90%, because a shift in the interest rate would, or a shift in their income would have a much greater effect on their ability to repay that.
What we've done also, we've introduced for some of the segments, collateral replacement insurances, where we can lend to you, but there's an insurance that can take care of any loss of value. So those are some of the things we have included. The other bit which we've done is working with developers, because at the end of the day, if you can work with a developer and the terms are friendly on their side, it means they are likely to also give you a better product at the end. So again, now the third bit around the affordable housing initiative that we've done with the KMRC, we're looking to also unlock that opportunity where we give you a longer term, and it's a fixed rate in the short run. That's what we're looking to do. And that again allows you to balance the options that you're looking at in terms of the property you're buying. But also we believe, as you have rightly put, we are not at a risk of a market crash anytime soon.
Sure.
Yeah.
Okay, thank you. I'm afraid that's all we've got time for today. There are quite a number of questions that I simply haven't had time to get to that have come through on the chat, but we will answer them all on the chat. So that really just leaves me to say thank you very much, firstly, to ABSA for inviting us, Knight Frank, here today. I'd like to thank my panelists, Charles, John and Tarquin, for taking time to answer those questions, many of which I wouldn't have been able to answer myself, so I'm very relieved to have had such a distinguished panel today. And of course, to thank you, the customers of ABSA, for attending today in such abundance, I might say, and also for participating in such a fantastic way and asking such great questions. I hope we have managed to answer the ones that we've had time for to your satisfaction, but as I say, we will also address the others on the chat itself. So thank you very much. And if I can hand over to Simon for some closing remarks.
Thank you, Ben. Really pleased for that session. Really exciting session. Very, very engaging. Thank you, John. Thanks, Charles and Tarquin, the Knight Frank team, for joining us today. There are a lot of questions that have gone unanswered just because it's a huge engagement. So don't worry. What we're going to do is that we're going to list those questions. We'll have Ben and the team look at them. Then we'll circulate an FAQ with those questions and circulate to the entire team that has attended the session. A few other comments as we close. There's a survey that will come up just after I'm done here. Please give us feedback on whether this session was useful to you. and also other sessions that you'd love us to touch on. We like to check ourselves to make sure that we are giving you value. From the engagements I've seen and the attendance, then it does show that there's some great value, Ben, and thank you to you and the Knight Frank team as well as John for the support. We'll also share the recording of this. It's going to be posted on YouTube, but beyond that, your relationship manager will send you the link just to make sure that you have access to it. We'll share also the presentation that Ben just did, showing the indices and the trends that Charles has probably put together. It will also have their contacts. I'm sure many of you have more questions. You'll have to have probably a private engagement. We'd highly recommend, and we are sure that the team is going to handle your questions very well. The other key point is around your relationship manager. Please give them feedback as well. They took time to actually invite you. We'd love to hear what you think about this, what you think about Knight Frank. If you're interested in a mortgage, if you have a property that you'd like listed that is supposed to be sold, or more advice that you'd like in terms of linkage. I think that's pretty much it from me. In terms of what to expect this year, I did mention we have a series of 12 events. They're built around the areas that you have highlighted as most important to you. Just to give you an insight into what we expect as the next event, we will be, again with Ben, interestingly, we'll be doing the 2022 Wealth Report, just looking at what are the really wealthy people, where are they investing, what are the trends that we are seeing in terms of where they're purchasing. He asked a question, what can $1 million buy you in which city across the world? So we'll be looking at the Wealth Report, so look out for that sometime in the 3rd week of March next month. And we'll also be sharing more insights as to the other areas that you have brought up. From me and the entire Premier team, your relationship managers, as well as everybody that serves you in ABSA, it's just to thank you very much and really appreciate that you've taken your time, that 1.5 hours, really to share your feedback and also questions as well as inquiries with us. Thank you from the ABSA team and Knight Frank team. Have a good day. Bye-bye.